I'm Hannah Wallace and welcome to FinextraTV. Kindly calling into our virtual studio today to speak about the Economist Intelligence Unit report is Kanika Hope, Chief Strategy Officer at Temenos. So Kanika, welcome back. It's good to have you on.
Hi Hannah, good to be back.
Really good to have you on and looking forward to catching up and hearing about some of the key findings from the Economist Intelligence Unit report. But firstly, perhaps you could introduce the report for us and tell us what was the thinking behind it. Let's start there.
Sure. We're delighted to launch the 2021 Economist Intelligence Unit report this year. Branching out, can banks move from city centres to digital ecosystems? This is the 8th consecutive year that we have commissioned this independent research. We've interviewed over 300 bankers from across the globe, from retail, corporate and private banks. 50% of them C-suite. And the idea behind it is to explore banking trends, to understand how new technologies are shaping banks' digital agendas and where banks are focusing their digital investment.
All right, and it highlights findings about the potential end of the current branch-based model, doesn't it? So how do you interpret this, particularly in light of the recent COVID pandemic? What about that?
Sure. The theme of the report is the shift to digital banking and the rapid fall of cash and the use of the branch as a channel. The percentage of respondents agreeing with the statement about the end of the branch-based model as we know it has doubled since 2018. In the developed world, branches are closing faster than ever, and as we know, the pandemic has only accelerated this. If we look at the UK as an example, branch closures in 2021 have already outstripped the total branch closures in 2020. And when we look at the run-up, the previous 10 years, branches had already halved in the UK. So this is being driven by the uptake of digital banking and the reluctance of customers to go into a branch. For instance, in the UK, 63% of UK customers in a survey recently said that they reduced or stopped using the branch since the pandemic. Another interesting finding in our survey, 81% of the respondents said that banks will differentiate on customer experience as opposed to products. The focus has moved from driving customers towards digital channels to re-injecting customer intimacy into these channels. For example, chatbots or hybrid integrated video chats with human and digital touchpoints delivered at scale. Now, there's a geographic slant to this, of course. In North America and Europe, the focus is more on customer experience. And in the emerging markets of Latin America and Asia, they're still focusing on moving customers to digital channels. But all in all, this report's findings lead us to believe that today's branch-based model will morph into new hybrid digital and assisted models, augmented by a new kind of branch centered on customer experience.
All right, that's really interesting. And in the overall banking trends highlighted by the report, we see that new technologies are reconfirmed as the most impactful driver, ranking higher than, say, regulation and customer demand, which is really interesting. So perhaps you could comment on this trend.
This year, 65% of respondents said that new technologies will continue to drive global banking in the next 5 years, over regulation and customer demand. Now, this is a steady trend we've been observing for a few years. The fact is that today, both customer demand and regulation are driven by technology. Customers expect a banking experience similar to what they get from an Amazon or an Uber, these consumer-oriented technology-driven giants who are harnessing the disruptive technologies to their advantage. And regulation is no longer just about risk and compliance, it's about innovation, it's about competition. Regulators are actively pursuing and encouraging sandboxes and collaboration and open banking. Central banks are launching or toying with the idea of launching digital currencies. So these technologies are profoundly changing the way banking services are delivered and consumed and indeed regulated. Banks are seeing these new technologies as a way to drive new business models quickly and cost effectively because these technologies offer agility, flexibility, and at the same time, they ensure resilience and security, which are the cornerstones of a regulated industry like banking. In this year's survey, another interesting finding was that 86% of bankers believe that DevOps and cloud will drive core banking transformation. This chimes with the conversations we are having with our clients who predict that packaged software built on these technologies will potentially deliver functionality 20 times faster and be 10 times cheaper to run.
All right, very interesting. Thank you for taking us through that finding. And also, we saw that the report finds 47% of bank executives expect their businesses to evolve into ecosystems in the next 2 years. So With that in mind, how do you see open banking evolving? What about that?
Open banking remains a key trend in the Economist Intelligence Unit report. Over 80% of bankers are predicting the platformization of banking by 2025. Banks see the inevitable need to collaborate with multiple parties in a wider digital ecosystem. And as you said, nearly 50% of them want to act as true digital ecosystems where they essentially retain control of the customer and orchestrate other players on their own platform. Now, open banking is more mature in Europe and in Asia Pacific, notably in China, which has the e-commerce and payment disruptors, the giants, the Alibabas, etc. But it is gaining ground in 40 plus countries across the globe, driven largely by regulation, but also by market forces. In response, most large banks are pursuing a variety of business models. So, for instance, Standard Chartered, which is cited in our report, is setting up multi-country digital challengers in Africa to cater to the unbanked population. Then they are collaborating with a travel agency and a telco in Hong Kong to set up a digital bank called MOX. And in a country like Indonesia, they're pursuing banking as a service.
Mm-hmm. All right, so could you comment on banking as a service? What are your thoughts there?
As open banking morphs into open finance, you move into products beyond traditional banking products like pensions, etc. And open finance becomes embedded into the customer journeys offered by digital platforms. We see banking getting subsumed into cross-industry digital ecosystems through banking as a service models. So built on the foundations of open banking frameworks, BaaS has really come into its own since the COVID-19 pandemic. What is it? It is the provision of complete banking processes, deposits, loans, payments as a service from specialist cloud-based API platforms that use a licensed bank's secure and regulated infrastructure to deliver the financial service at the point of need, which is embedded finance. And it is predicated on modern technology, offering open APIs, modularity, hyper-personalization, and the highest levels of resilience and security, all delivered as SaaS or software as a service.
So watch this space, some really interesting developments ahead there. And as always, Kanika, brilliant to listen to your insights. Thank you very much for sharing them with us, and I hope to catch up further down the line.
Thank you, Hannah.